Okay, so still talking about the accounting equation. We talked about assets extensively or relatively extensively, and we also talked about liabilities, and we gave different examples of each. Now let's zero in on the equity element of the accounting equation. And the equity is more involved than the first two. So we said that the equity, they are claims to the assets of the business. Another word for equity is investment, or we also call it contributions, okay? Owners' contributions, okay? Now, let's take a look at, and we also call it stockholders' equity. Owners of corporation are called stockholders. We also call them shareholders. Those two words are used interchangeably. Now let's take a look at the increases in equity. Now, when the owner of the company contribute money into the company, we call it contributed capital. So that is the name or the bucket or the account that we use to keep track of owner's contribution or investment into the company. Now, revenues increases equity. Now, it's important for you to know this at this point. What are revenues? Revenues are the money the company generates either for providing services to customers or selling goods. Now, as you are going to see in this course, we are going to learn a lot of accounting terms or terminology, okay? Now, every company primarily do one or two things. A company either provide services for their customers or they sell goods to their customers primarily. Now, the money or the amount that the company generates for either providing services or selling goods, we have a fancy name for it. We call it revenues in accounting. So when the company generates revenue, obviously that increases the equity or the investment of the owner. So let's take a look at things that decrease equity of the owners. Dividends. Okay, those are owner distribution. What are dividends? That's another fancy name. Remember, why do people start business? And what is business existing for? Primarily, we all know that the business exists to make money. In a layman's term, we call it profit, right? Now, the profit belongs to whom? Obviously, the owner or owners of the company. So for a corporation, when you take part of the profit or some of the profit or all of the profit and give it to the owner or owners of the company, we just give it another fancy name. We call it dividends. Just like if you put money in the savings account, the money that you earn by putting the money into the savings account, we call it interest. But here's another one. We call it dividend. This is a profit given to the owners. So we call that owner's distribution. And dividends decrease equity of the company. Now look at expenses. Another fancy word. Expenses also decrease equity. How? Because you already know that it takes money, you have to spend money to make money, right? So the cost that is involved in making money in business, we call it expense. So expense obviously will decrease owner's equity. Now, like I said, equity is very involved, and we have 3 slides explaining equity. Now, we said that equity consists of 2 components, 2 main components. You need to carry this. And we call contributed capital and retained earnings. Okay, you need to carry this. This is very important. Now, what is contributed capital? Contributed capital is the capital or investment that the owner or owners contribute to the company. Remember the $30,000 example that I discussed with you initially? The owner of the company started the company and issued $30,000 from his personal checking account and give it to the business. That is contribution. I know that most of you must have heard that. A lot of people say, well, one of the challenges that I'm having in starting my own company is I don't have enough capital. Okay, so that is contributed capital. Now, another component of the equity is called retained earnings. Oh, this is another fancy word. I know that some of you have not come across before. You need to catch this. This is very important. Very, very important. Earnings. Another name for earnings in business is also called profit. I know most of you must have heard this word, profit. We used to call it profit long time ago, but in accounting, the official name that we call it is actually net income. We are going to talk about this eventually. Now, listen, you need to catch this. One of the challenges of this class, or accounting for that matter, is sometimes you have one thing with multiple names. And this is a classic example. Earnings is the same thing as profit or net profit, and the same thing as net income. So what are we talking about here? Catch this. So when a company makes $10 million profit, and they decide to give $7 million to the owners, what do we call that $7 million that they give to the owner? Anybody remember? Remember we talked about when you take some of the profit to the owners, we just give it another fancy name. We call it what? Dividend. So they give $7 million of $10 million to the owners and pay them. We call it dividends. The $3 million, the company decided to leave it inside the company so that they can have enough money to expand the company or do what other things. That $3 million that we leave in the company, we call it what? Retained earnings or retained profit or retained income. Okay? So the profit that is not distributed, or the net income that is not distributed to the owner, that is kept in the business, is still belong to the owners of the company. So we say that these are the two primary categories of equity: contributed capital, retained earnings. Make a note of that. That's going to be on your exam. Now let's take a look at contributed capital. All right. We also call it paid-in capital. I just told you. One thing have what? Multiple names. Look at it. They said contributed capital is also called what? Paid-in capital. It is the amount invested into the corporation. Now, when the owner invests money into the company and the owner gives the company $30,000, the company has to give the owner something in return, and we call that stock. What is a stock? A stock is a piece of paper that serves as evidence of somebody's ownership of a corporation. So if you go to IBM, if you go to downtown tomorrow and buy IBM stock or General Motors stock, they will give you a piece of paper. It's a certificate, and they call it stock. That is evidence that you have ownership of General Motors. Okay, so the company will issue common stock, and that represents your ownership of a company. Now, at this point in time, let me quickly share something with you. I think it is not too late. Stock versus share. Do you know the difference? Listen, these two words are used interchangeably, but they mean two separate things. A stock, like I said, is simply a certificate or a piece of paper that serves as evidence of your ownership of a corporation. Whereas a share is a unit of stock. What does that mean? If I go to downtown tomorrow and buy 100 shares of IBM stock, and you buy 5 shares of IBM stock, clearly I have more ownership of IBM than you with only 5 shares. So how much ownership do we have of a corporation is demonstrated by is evidenced by the number of shares that we have. So you say, I have 100 shares of IBM. you will say you have 5 shares of IBM. So stock, share are not the same thing. So moving along, the last slide, talking about equity. Now, like I told you earlier, look at this. This is very simple and straightforward. Oops. Oh, yeah. Look at it. We talk about assets, the definition of assets, and different types of assets. We talk about definition of liabilities, different types of liabilities. No sweat. And guess what? Equity is very involved. So we need to spend a lot of time on the equity part of the accounting equation for you to have a good understanding. Now let's take a look at that. Basically, in summary, what we just discussed. Look at, we said equity is divided into 2 parts. Contributed capital plus what? Retained earnings. So these are the 2 parts of equity. Under contributed capital, we have an account or a bucket. We keep track of owner's investment in an account called common stock. Anytime the owner put money into the company, we record it in common stock account. Then we have dividends. We just talked about that, right? A part of the profit that the company gives to the owners. Then we have revenues. We just talked about that. Revenues are the money that you generate by providing services to customers or selling goods to customers. Then we have expenses. And those are the costs for running the business, okay? So these are all 1, 2, 3, 4. They are all sub 1, 2, 3 are under retained earnings, common stock under contributed capital. Now, in summary, look at what we have here. We are going to discuss this in details eventually. Look at this. You're already familiar with this. Revenues, like we said, are money that you generate during the course of doing your business, the cost of doing business. So when revenues are greater than expenses, we have net income. Once upon a time, we used to call it net profit. If you read the newspapers, a lot of newspapers still use the word net profit or profit because regular people on the street can easily relate to that term profit. But in accounting, we don't call it profit anymore. We call it net income. All right? So look at this. When revenues are less than expenses, in other words, when you spend more than what you make, we call it net loss. Once upon a time, we used to call it net loss. Where net profit, net loss, same thing. Now, moving along, let's take a look at this point in time, I think this would be a good point to cut off part 2 of the presentation.